What if I told you there is like a 97% mathematical probability that the incoming chair of the Federal Reserve is just using artificial intelligence as a, well, as a cover story to appease the White House?
I mean, it sounds wild, right? But the underlying dynamic we are looking at today is this textbook collision between an immovable macroeconomic reality and an irresistible political force.
Yeah. Exactly.
We have this severe supply-side energy shock happening at the exact same moment the executive branch is putting unprecedented pressure on the very institution designed to manage that shock.
Welcome to the deep dive. I'm so glad you could join us today.
Yeah, we've got a really fascinating one for you.
We really do. So our mission today is to decode what is really happening at the very top of the U.S. financial system. And our source material for this is a brand new paper. It's titled centralbank.pdf, and it was published just today, April 23, 2026.
Right, by the economic consulting firm Dr. Novin and Associates.
Exactly. And basically, this paper deconstructs the April 21 Senate confirmation hearing of Kevin Warsh.
Who, just for context, was nominated by President Donald Trump back on January 30, 2026, to succeed Jerome Powell as Fed chair.
Right. Now, before we go any further, I do want to establish a very explicit baseline here, because this is important.
Yeah, absolutely.
Because this paper directly analyzes things like executive branch pressures, President Trump, and the institutional integrity of Federal Reserve leadership. We are obviously operating in an inherently charged political ecosystem.
Oh, without a doubt.
So for you listening, please know that we are not taking any sides today. We are not endorsing any of the viewpoints or policies or political actors mentioned in this analysis.
Right. Our sole mandate is just to impartially report on the quantitative and qualitative findings that Dr. Novin and Associates provided. We're just conveying the ideas in the source material.
Exactly. We're just the messengers here. So to kick us off, can you set the stage for us? Why is Kevin Warsh's nomination happening in an environment that the paper calls, quote, structurally different from the historical norm?
Well, it's critical to understand that the paper treats this political pressure not as some partisan issue, but actually as a structural variable in their economic model.
Okay, interesting.
Yeah. Dr. Novin's analysis posits that the Federal Reserve is currently operating in an environment completely detached from historical norms. Like over the past year or so, the executive branch's criticism of outgoing chair Jerome Powell evolved from just, standard debates over interest rates.
Into, like, systemic delegitimization.
Exactly. The attacks were targeting his competence, his integrity, and even the very legal insulation of the Fed itself.
And then there's the DOJ investigation, too.
Right. The Department of Justice investigation into Federal Reserve governance decisions is really the ultimate manifestation of that structural shift.
I mean, we aren't just talking about a president tweeting or giving verbal pressure anymore.
No, not at all. We're looking at formal legal challenges regarding the actual scope of executive authority over central bank appointments.
Wow.
So the incentive structure for any incoming policymaker is just completely warped right now.
Because they're not just looking at the economy anymore.
Exactly. They are no longer simply optimizing for their dual mandate, maximum employment and price stability. They are actively pricing in the institutional cost of diverging from what the executive branch wants.
Which is an accommodative or loose monetary policy.
Right. And the historical parallel the paper draws here is really critical. You have to look back to the 1970s.
Oh, the Arthur Burns era?
Yep. Specifically, the dynamic between Richard Nixon and Fed Chair Arthur Burns to find any comparable level of institutional friction.
Burns is the one who famously succumbed to executive pressure, right?
He did. He kept monetary policy loose leading up to an election, even though inflationary pressures were mounting.
And that didn't end well.
No, that capitulation critically unanchored inflation expectations. It basically set the stage for a whole decade of stagflation.
Wow. And the paper argues we're staring down a structurally similar vulnerability today.
Exactly, but the stakes are even higher now because of the immediate macroeconomic backdrop.
Right, because the timing of this institutional vulnerability just couldn't be worse. All this political pressure is colliding with a massive macroeconomic wall.
The global economic crisis.
Yeah. In early 2026, the U.S.-Iran conflict escalated, and that led to severe, sustained disruptions in the Strait of Hormuz.
Which is a massive bottleneck for global oil.
Huge. So we immediately saw this massive supply-side shock injected into the data. Global oil prices just spiked.
And that bleeds directly into headline inflation.
Right, through manufacturing, logistics, base energy costs. I mean, we are looking at a textbook stagflation trigger.
In a standard macroeconomic framework, an exogenous supply shock that drives up inflation like that demands a hawkish response.
Right, the central bank needs to tighten monetary conditions, raise rates.
Exactly. Ensure those temporary energy price spikes don't become permanently embedded in long-term wage and price setting. You have to cool aggregate demand to meet the newly constrained supply.
Okay, let's unpack this for a second. Because standard economics dictates that when inflation is high, you tighten policy. It's like trying to cool down a boiling pot, right? You don't turn up the heat.
No, you definitely don't.
So why is there any discussion of an easing bias under these conditions? The paper highlights that the incoming leadership is telegraphing a desire to loosen policy.
Yeah.
Why?
Well, to justify turning up the heat on a boiling pot, you need a brand new playbook.
Okay.
And that contradiction is the central puzzle of the paper. Warsh is nominated into an environment that clearly demands tight money to fight an energy shock, but the executive branch demands loose money.
So how does he navigate that?
This leads directly to the unconventional narrative he introduced during his April 21st testimony.
Right, the testimony. He introduced what the paper terms a new inflation framework.
Yeah, and what's fascinating here is how he frames it.
He still promised central bank independence, of course.
Yeah, of course. But alongside those standard pledges, he argued that the anticipated productivity gains from artificial intelligence will be so massive, so revolutionary, that they will naturally exert downward pressure on inflation.
Basically neutralizing the current energy shock.
Exactly. What's fascinating here is that he is attempting to artificially expand what economists call the feasible policy set.
What does that mean in practice?
If a central banker can convince the market that a massive deflationary wave of technological productivity is right around the corner, it creates conceptual space, right?
Oh, I see.
It creates the theoretical justification for the Fed to adopt a more accommodative stance right now, despite the oil shocks.
And it allows him to signal a dovish trajectory to the executive branch without overtly sounding like a political puppet.
Precisely. He doesn't have to abandon the language of forward-looking economic analysis.
Well, wait, the paper aggressively pushes back on this, right?
Oh, very aggressively.
Because relying on AI to solve an immediate energy-driven inflation shock is, well, it's like burning down a forest to power the factory that builds solar panels.
It's a great analogy.
I mean, the long-term efficiency of the solar panels might be real, but the short-term resource burn actually accelerates your immediate crisis.
Exactly. The paper looks at the actual mechanics of AI deployment. It's incredibly resource-intensive.
Yeah. Large-scale AI investment requires staggering capital expenditure. You need massive data centers, specialized silicon, advanced cooling infrastructure.
And above all, energy. Baseload power.
Right. And since we are already in an energy supply crisis due to the Strait of Hormuz disruptions, wouldn't a massive AI boom actually increase near-term inflation by demanding more of these constrained resources?
Yes, exactly. The competition for those resources is inherently inflationary in the near term. The AI infrastructure build-out directly competes for the very credit, copper, and grid capacity that the Fed is supposed to be managing.
So the narrative has some major empirical holes.
It does, and the paper contrasts this dynamic with the 1990s internet boom.
Oh, interesting. How is that different?
Well, during that era, the aggregate productivity gains were already visible in the macroeconomic data, and inflation was already trending downward.
So Alan Greenspan actually had empirical proof to justify an accommodative stance.
Exactly. But today, as Dr. Novin points out, the macroeconomic effects of AI are totally different. They are unevenly distributed, heavily siloed, and entirely speculative on an aggregate level.
So if the empirical data contradicts the narrative, and AI capital expenditure exacerbates the immediate energy shock, why does a highly credentialed nominee stake his Senate confirmation on it?
That is the million-dollar question. If the AI argument fails as a strict macroeconomic forecast, it must be succeeding as something else.
The strategic mechanism.
Exactly. And this is where the paper transitions from macroeconomic critique into game theory.
Here's where it gets really interesting. I mean, applying Bayesian game theory to a Senate confirmation hearing, that is a remarkably rigorous way to cut through political rhetoric.
It really is. They use a Bayesian signaling model to mathematically evaluate Warsh's testimony.
Basically trying to mathematically prove whether this AI framework is a genuine policy belief or just a calculated political signal.
Right. And for those who might not use Bayes' theorem every day, it's essentially a mathematical framework designed to update the probability of a hypothesis as more evidence or information becomes available.
So Dr. Novin's team is attempting to calculate the probability that the nominee is secretly aligned with the executive branch's easing preference versus being strictly independent.
Exactly. And to build this model, they established some conservative prior probabilities.
Walk us through the math a bit. How do they set it up without getting too bogged down?
Sure. They ask a very specific question. What is the probability that a policymaker who is fundamentally aligned with the executive branch would deploy this exact AI productivity narrative?
And what do they estimate that at?
They estimate this likelihood at 95%.
Wow, 95%.
Yeah. And the reason for that high number is the sheer elegance of the narrative itself.
Right, because an aligned policymaker needs a cover story.
Exactly. If your objective is to justify lower rates during an inflation shock, you can't just say the president wants it. You need a macroeconomic cover story.
And the AI narrative is perfect for that. It's grounded in a trendy topic, it has some micro-level proof, but its macro effects are inherently difficult to falsify in the short term.
It's the ultimate narrative shield. It fulfills the political mandate for loose money while maintaining a veneer of sophisticated, forward-looking economic analysis.
Okay, so that's the aligned side. What about the independent side?
Conversely, the paper asks, what is the probability that a strictly independent policymaker, one exclusively focused on current empirical data and the dual mandate, would adopt this unproven framework during a tangible energy shock?
Right, someone just looking at the facts.
The authors set that probability at a highly conservative 7%.
Just 7%.
Yes, because an independent central banker relies on realized data, not future tech speculation. Especially when current infrastructure demands for AI are actively exacerbating the inflationary pressure.
Right, they wouldn't risk their credibility on a guess. So we have the core inputs for Bayes' theorem. We take the prior probability of alignment, multiply it by the likelihood of observing the AI narrative, given that alignment.
And then divide it by the total marginal probability of the narrative being used at all.
Right, and when Dr. Novin plugs these inputs into the model, what does it output?
The math yields a staggering 97% posterior probability.
97%. So there's almost a 100% chance he's signaling alignment.
The quantitative conclusion is unambiguous, and what's impressive is they stress test the model, too.
By changing the assumptions.
Exactly. And when they tweak the parameters, like lowering the probability of the aligned signal or raising the probability of the independent signal, the posterior probability alignment consistently remains above 88%.
So no matter how you slice it, the math points to political alignment.
Robustly. It demonstrates that the AI narrative is mathematically consistent with strategic signaling by an aligned policymaker and highly inconsistent with independent economic analysis.
That is just wild. And you touched on this earlier, but the strategic brilliance of using AI specifically is its falsifiability, or I guess lack thereof.
Right, because it's in the future.
You pointed out the 90s tech boom had visible data. But the macroeconomic impact of AI over the next 5 years, that is inherently difficult to falsify today.
Exactly. If an aligned policymaker claims AI will suppress inflation in 2029, no macroeconomist can definitively prove them wrong in 2026.
It creates this sort of asynchronous accountability loop.
That's a perfect way to phrase it. The policy easing happens immediately, delivering the political payoff to the executive branch right now.
But the empirical validation of that justification is deferred indefinitely into the future.
Right. By the time the aggregate data actually proves or disproves the AI disinflation hypothesis, the current economic cycle and potentially the political cycle will have already turned.
It's a very clever political shield. But the Bayesian model only measures the intent of the signal, right?
Correct. It just measures what Warsh is trying to do.
So what does this all mean for the real world? The paper pivots to the actual receptor of that signal, the global financial market.
Yes. This is where the rubber meets the road.
If Warsh is signaling an accommodative stance using this hard-to-falsify AI narrative, the crucial question is the rest of the financial world buying it?
And the short answer is no. Financial markets are not persuaded.
Not at all.
The financial markets serve as a real-time, independent auditor of central bank credibility. And the paper's analysis of the bond market reaction during and immediately following Warsh's testimony is pretty damning.
Because if institutional investors actually believed the AI disinflation narrative, if they genuinely anticipated a massive wave of future productivity driving down prices, Long-term Treasury yield should have dropped, right?
Exactly, they should have compressed.
But instead, we saw the exact opposite.
The paper details a sharp sell-off at the long end of the curve. Long-term yields went up.
So the bond market basically looked past the AI rhetoric, identified that 97% probability of political alignment, and just started pricing in inflation.
Immediately, they began pricing in a structurally higher term premium. Investors are demanding significantly higher compensation to hold long-dated U.S. debt because they recognize that inflation expectations are becoming unanchored.
So we are witnessing a classic bear steepening of the yield curve.
Yes, and it's driven not by growth optimism, but by inflation fear and credibility erosion.
The short end of the curve stays anchored because they expect the Fed to lower overnight rates for political reasons.
But the long end is violently rejecting the central bank's forward guidance.
And I want to relate this back to you, the listener, and your wallet, because this isn't just Wall Street jargon. For anyone holding a 30-year fixed mortgage or, trying to buy a house, this policy divergence is a nightmare.
It's the absolute worst-case scenario.
The Fed might artificially suppress the overnight rate to appease the executive branch, but because the bond market is panicking about unchecked inflation, the actual borrowing costs flowing through the real economy surge higher anyway.
Mortgages, corporate bonds, long-term loans, they all become more expensive.
Exactly. And the fiscal implications are just as severe, right?
Oh, massive. The U.S. Treasury has to constantly roll over a huge sovereign debt burden. If the market demands a structurally higher term premium due to this loss of credibility, the debt servicing costs for the federal government will explode.
Creating a brutal fiscal squeeze, precisely when the economy is navigating a supply-side oil shock.
It's a perfect storm.
And it doesn't stop at the U.S. border. Because the U.S. dollar is the foundational asset of the global financial system, this domestic credibility crisis immediately metastasizes into a global spillover event.
Right. The paper outlines these broader consequences very clearly. A structurally more accommodative U.S. monetary policy, operating out of step with global inflation realities, puts immense downward pressure on the U.S. dollar.
The DXY index just drops.
Exactly. And a rapidly weakening dollar fundamentally alters international capital flows. Investors seek positive, real returns.
So if the U.S. central bank is artificially keeping rates below inflation, capital is going to flee.
It will flee U.S. assets for jurisdictions with independent central banks that are willing to maintain positive real rates.
And that forces foreign central banks to react.
Yes, particularly in emerging markets. They either have to absorb imported inflation as their currencies fluctuate against the dollar, or defensively hike their own rates, which chokes off global growth.
If we connect this to the bigger picture, the most dangerous spillover isn't even just financial, is it?
No, it's institutional. This is the ultimate casualty mapped out in Dr. Novin's paper. It isn't just the purchasing power of the dollar, it is the concept of monetary independence itself.
Institutional contagion.
Exactly. The U.S. Federal Reserve has historically provided the normative anchor for global central banking.
They set the standard.
Right. And if global markets internalize that the Fed can be mathematically proven to use strategic, unfalsifiable narratives to mask political compliance, well, that shield is shattered everywhere.
So the unwritten norms that protect central banks in Europe, Asia, Latin America from their own executive branches, those are heavily reliant on the precedent set by the Fed.
Precisely. Once the anchor institution capitulates, it creates permission structures for executive branches worldwide to demand similar accommodations.
We risk regressing to a global regime of fiscal dominance,
where monetary policy is universally subordinated to political timelines rather than macroeconomic stability.
Wow. So, tracing the through line of this entire analysis, we begin with intense executive branch pressure and a DOJ investigation systematically dismantling the Fed's institutional insulation.
Right.
This political vulnerability perfectly coincides with the Strait of Hormuz disruptions, which triggers a massive energy shock that demands hawkish tightening.
But instead of tightening, the incoming chair introduces an AI productivity framework to justify dovish policy.
A framework that Dr. Novin's Bayesian signaling model demonstrates, with 97% probability, is a strategic narrative shield designed to mask political alignment.
But the mechanism fails at the market level.
Exactly. The bond market rejects the AI narrative, driving long-term yields higher, punishing the real economy, and triggering global capital flow disruptions that threaten the very primacy of the U.S. dollar.
Dr. Novin and Associates have essentially provided a real-time autopsy of a credibility crisis happening in plain sight.
It's incredible. It really forces a fundamental reevaluation of institutional stability.
It does. We tend to treat central bank independence as this immutable law of modern finance, like it's hard-coded into the global economy.
Right.
But this paper mathematically exposes that independence as a fragile ecosystem of behaviors and market expectations.
It's just norms.
Exactly. And it leaves you with this lingering thought. If the bond market definitively concludes that the institution issuing the world's reserve currency is making policy based on strategic political narratives rather than empirical data, what happens to the value of the money in our pockets?
Right. Because fiat currency, stripped of everything else, is simply a shared belief in the credibility of the issuing institution.
That's all it is.
When that credibility is mathematically proven to be compromised, the foundation of the entire financial system shakes.
It's a fascinating and slightly terrifying prospect to mull over.
It really is. Well, thank you for joining us on this deep dive. It has been a fascinating journey unpacking the hidden mechanics of monetary policy with you.
Always a pleasure.
Keep questioning the strategic narratives behind the economic data. Keep looking for those underlying incentive structures, and we will catch you on the next deep dive.